So to put it in perspective, the US is about 25% of the global economy. Yet they have 100% equivalent of global GDP in debt. So this is the most indebted economy in the history of world economics in terms of global debt, because it's so big. Now, the US is not the only one here. Europe's got massive debts. Japan's got massive debts. So China's got big debts. Everyone's got debts because we borrowed for our future selves. Average works in crypto that you have some Bitcoin and you want to borrow some more Bitcoin or some US dollars or whatever it is you want to do. So you will pledge your Bitcoin and your interest payments as collateral, and your interest payments are whatever they are. But what happens is if the collateral falls and the exchange or whoever it is, or the DeFi protocol says, oh, it doesn't cover the amount, you get liquidated immediately. There's no negotiation, no, oh, please, no, nothing, just like boom, out, and you take the loss.
Because they're saying, hey, you've reached the point at which what you owe us, the value of what you owe us has now been reached. And so if I don't take this back now, I run the risk of it dropping even lower. And now I'm out and I'm not going to let that happen. So it's like a house you can repossess instantaneously.
Correct.
And now you're out of the market. You don't get if it dipped down even like a penny, it's gone. And so now if it bounced back up, you're still done, gone.
Out of the market, that's right.
Whoa. Okay.
Well, it depends what we're talking about. Look, I mean, they've made it clear, the central banks and the government, that they want everybody to take a shot to the face, i.e. they want demand to go down. And I think that's already happening quite fast.
Well, I've heard that said. I don't understand. Demand for what?
Stuff. So if they put up your mortgage rates, you spend less in restaurants. If you're finding that your food bills at the supermarket are 30% higher than they were, you spend less on something else, right?
Why is that ever good?
Because it stops the price of goods rising. So the price of goods moves either because there's not enough supply, which is what we've had a problem with, or it's because there's too much or not enough demand. So if you've got something with restricted supply, so let's think of oil right now. Because of the Russian situation, there is not enough oil for the current demand out there. So the oil price keeps going up. So you and I pay more to drive our cars or to heat or cool our houses. So the only way of solving that one, because you can't get the Russian oil back into the market, is to make us use less oil. So that the price does that automatically because it gets more expensive, we do it. But if you can also then just lower general demand for things, we'll drive our cars less, we'll catch less flights, all of that stuff, and that lowers demand and therefore prices. Because prices rising, inflation, is evil for our savings, because the dollar in your bank account is worth less in a year's time. It's currently worth 8% less, which is quite a lot. And so it's this weird situation where we have to take the pain. We're told we can't buy as much, and we're forced into it by rising our mortgage costs and our food costs and all of this stuff. And eventually things will slow down. People will be put out of jobs a bit, that kind of stuff. And then the overall demand in the economy comes down and prices come down. So we're all collectively taking the pain for this inflation that was created out of a whole bunch of different things, from the pandemic through to supply chain issues, through to underinvestment in commodities, through to the shift to green energy. All of these things have created this moment in time, which is tricky. And, if we relate it to, for example, the crypto market. So why did crypto stop going up? Well, it was macroeconomic factors, and people are like, well, what's that got to do with crypto? Well, really simple is it's a retail-based market. And about sometime last year, prices started to rise. And so people could afford to dollar cost average less. So then there's less demand for crypto and the price of crypto falls. It's as simple as that. The Fed can engineer it by trying to raise interest rates, and it filters through to our mortgages and other stuff. Or the market kind of clears of its own accord, where prices get too much, people stop buying stuff, prices fall back again. So either way tends to work. And we're in this weird mess where the Federal Reserve are doing it, the markets are doing it, and we're having to take all the pain in the meantime. I generally think that the market is better at doing it. If you actually see it, from my perspective, somebody who closely follows interest rate markets and stuff like that, they did all of the tightening anyway, well before the Fed. You hear the expression, the Fed are behind the curve. What it means is the bond market's already priced it. Like, interest rates need to go up to slow down the economy because there's too much inflation, and the Federal Reserve are trying to catch up. I actually think the markets do a pretty decent job in the way that you suggest. Prices rise, eventually it gets too expensive, we stop doing it. Now, there's different equations that people fear is when it becomes super entrenched in the economy and we all go to our bosses and go, I want a pay rise. And everybody does that at the same time. That pushes up prices further. You get more wage rises, and that's a wage price spiral. That really has only happened in the US really once, which was in the late 70s, early 80s, when all of the baby boomers hit kind of 30 years old at the same time. So if you think when you go back to 30, you're kind of settling down with somebody, you're probably thinking about buying a house, you're buying a car, you've got a job, you're starting to earn some money. We had the largest group of people in all history turning 30 at the same time. And they all did the same thing and bought the same stuff. And that really pushed up prices. And that was at the same time, there was issues with oil supply and other things. So we had this double whammy of a demand shock and a supply shock, which meant prices went crazy. But that's really only happened once. Leverage allows you to borrow future money to use now. So at two levels humans are terrible. We just want everything now. We don't want to work for it. If I can borrow it and buy that Rolex watch or my new car, right? We're trying to meet our future expectations of ourselves always. That's what drives humans. So that's why they use leverage. And it's the same with investments. So they do it for purchasing power, to bring that future expectations of themselves. Have I earned enough money to buy that car? No, but if I borrow money, I can get my future self here. It's kind of a trade-off because you're actually in debt and now owe somebody. You don't actually own the car. You own the ability to use the car until you pay that off. It's the same with a house, really. And the other point is for investments. People love to borrow money now because then you can make a bigger investment now. But the trade-off is what happens if that goes wrong? Then before you know, you get a margin call or liquidated. And that's a feature we see a lot in the crypto markets, for example. That happens kind of automatically. So humans just love this stuff because it brings their future expectations of themselves closer. I could be richer. I could have more stuff than I deserve now from my income. So when you go into the financial markets, like the futures markets, which is mainly for accredited or sophisticated investors, it's not an instant liquidation. And that's terrifying. Because suddenly, something like the oil price, let's say you've bought some oil futures, what that is leverage on the future price of oil. That's like you would do with Bitcoin. But oil sometimes can go down 10% a day. And because you've got leverage, before you know it, you're losing enormous sums of money. They don't liquidate you. They call you up and tell you owe them margin. And you can get yourself in a huge mess. So leverage is very scary. The nice way of playing leverage is options. Options is something definitely worth people learning about. And a lot of people learnt on Robinhood, because then you're only putting up what you can afford. If you say, I can afford to lose $1,000 on this bet, it's basically like the instant liquidation thing. And you can only lose the $1,000. But you don't lose your whole underlying position. You just lose the $1,000 you bet on the price of something going from here to there by whatever date. That's an options bet.
That's it for today, guys. If you found this video useful, then don't forget to like the video and share this knowledge with your friends and family. And don't forget to check out the full video, link is in the description. Thank you.